Hi everyone, a very good evening and welcome once again to yet another Edelweiss Konnect Klassroom sessions. Uh, Genuinely, we are very happy with the kind of response that we are getting for these sessions and appreciate your active participation and regular, interaction with us through this platform that we have created. Today, we are here with a very interesting topic. It's called step-by-step portfolio planning process. Now, when it comes to investments per se, a lot of us, either think that it is too easy. You see what's happening in the market, you kind of read some stuff, you decide on, what is the best sector, what is the best segment to invest. And basis that, make your investments, and then keep tracking them. And then as and when, you think that you derive decent returns, you kind of either profit book or you withdraw, depends on how you're looking at, how much money you need at that point in time when the situation comes. So that's one way. And then there are some people who think, it's a very complicated process. You need to understand a lot of things. And, somewhere in between this, a lot of investors somewhere get lost out. What is happening? So the point is, if I really want to make investments a very fulfilling and securing journey, I need to start looking at it in terms of creating a portfolio. And if I want to really create a portfolio for myself, it has to be something which is well thought out, which is something which is very well planned. Because otherwise, doing all the hard work of deciding how my portfolio should look and not knowing, what am I going to get out of this practice may feel even more cumbersome and tiring in terms of the journey. And hence, if you really want to be in a position where you feel more confident in terms of the investment choices that you have made, you feel more confident in managing, what the market situations throw at you, you need to start thinking about creating a portfolio. And creating a portfolio, like I said, requires a level of planning, a level of processing, a step-by-step process through which you can actually create a portfolio which is able to shock-proof itself from at least the general market anomalies. And that's what our endeavor today is going to be, to help you understand how can you create this portfolio through a very simple step-by-step process. So when it comes to investments, investments can either be, like I said, very simple, but for a lot of people, very honestly, investments are very daunting. They are overwhelming because number of choices are too many. There is too much information coming in the market. Sometimes somebody will say this is a good market cap to invest in. Small cap is doing well. Have you invested in a small cap? Mid cap is doing well. Have you invested in a mid cap? Auto sector is doing well. Do you have exposure in auto sector? Even if I just look at, one asset class, the kind of information overload that is coming. Quite honestly, investments can be a very overwhelming and daunting affair. And because of this, this thought in my mind that am I on the right side or the better side of investments where my money is going to get the better out of the returns. This is one return chasing thought in which most of us as investors are, and including a lot of us on this side of the table too. What happens is, my journey, instead of being something where I am feeling a little more confident, seems very daunting. Am I on the right track? Am I doing something right? And hence, I think it becomes even more important that we are able to take a step-by-step process and build a foundation through which I am myself first convinced that I am on the path of wealth creation. If I'm able to do that, and I'm able to create a portfolio which has the ability to withstand, volatility and different market situations to a great extent, I will be myself be in a much better position in my investment journey. Today, it's no longer enough that I made investments. Till a few years back, a few generations back, it was okay if you had certain investments because those investments, people usually had very simple requirements, right? And because they had very simple requirements, the investments somewhere kind of satiated those requirements well. Today, we are in a situation where we have needs, we have wants, we have aspirations, then we have impromptu urges to spend, and nothing wrong again, I mean, we are all working hard, we are all earning money. So why should we not do that? And hence, this thing that do I have enough is a question which is actually a very scary question for a lot of us. You will only know if we are able to build a portfolio with a purpose, and that's how you will be able to know that have I done enough. First things first, in this 5-step process, the step 1 is to know your finances. Get real about your finances. What do you own? What are your assets? Do you own real estate apart from the house that you're living in? Do you have any jewelry? Which is okay. What is your investment portfolio looking like? How much money do you have in your savings account? Know what do you own? Because this is very, very important. Because that's what creates your net worth. This is what is mine. And then obviously also know what do you owe. Do you have liabilities? Do you have a car loan? Do you have a personal loan? Do you have a housing loan? Any kind of debt that you need to repay, becomes very, very important because, the idea always is, if you can lower the liabilities, increase the assets. If you can't increase the assets, at least lower the liabilities as soon as possible, because that kind of relieves you to a great level of stress. But again, it's something which a lot of people today, are talking about, evaluating the cost of debt versus the cost of returns that you may make. So so there are different people with different versions and different thoughts, but you should know what your liabilities are. Know your cash flows. How much do you earn? How much do you spend? Very, very important. This thing, how much do we earn? A lot of us know. My problem is that a lot of us don't really know how much are we spending and where. It's true. And if you ask yourself, very few of us will be able to give us an exact number and a breakdown of where are we spending our money. You may know, okay, I need, let's say, 1 lakh rupees to run my house, 50,000 rupees to run my house, 2 lakh rupees, depending on your lifestyle. But where is this money going? That breakdown, we all should know. It's very important, because, as you say, the devil lies in the detail. When you get into the detailing part, then you'll know, are we spending too much? Are we spending too less? Whatever it may be. But that will only know when you know the details. We know from top, that this is the kind of money that I need for my lifestyle. Fair. But what is that elements that form your lifestyle? It could be that I go out 5 times a month. Okay, that's okay. I mean, you think you can't cut down because it's part of your lifestyle. Nobody is judging you, but you should know. You don't have to share it with anyone first. First, if I know, I will decide whether I want to share it with somebody in terms of getting help, or is this sufficient, or what am I doing? But you should know. And then you should know your portfolio, current investments. Again, this is one thing which I have seen for a lot of people, they don't know. They don't know where they are invested. How many insurance policies do they have? What are the value of the SIPs that they have made? Today it's become very simple. I mean, do you have a PPF account? If there's, then, when is it maturing? People don't know these simple details. Know your investments. Know what are they doing. Unless you know what are they doing, you will not know whether you're on the right track, what is the kind of returns that they are making. People tell me that I myself a big advocate of saying that we should not check our investments every day. And I totally buy that point. But you should know where your money is. What are your investments, right? These are two separate things. I'm not saying track every day, but you need to have an overall handle of what your investments are doing for you. And for that, you need to know where you invested. So get real about your finances, know your assets, know your liabilities, know your cash flows, know your investments. That's the first step. The second step is know your investment goals. I mean, I've spoken before also of this, but I think it's never enough because for us as investors, you know, we should know, we should have a reason for investing. You know, Imagine, like I keep saying, you've invested, and a lot of people say that I have invested for returns. Returns is fantastic. We love returns. I'm not taking anything away from it. But what are you going to do with those returns is what gives me happiness. You have to have a tangible element, and when you have that tangible element, it becomes something where you know that this is where I will enjoy my money, my returns, So always think of what is this investment going to do for you. Once you know what this investment is going to do for you, I mean, when the journey will end, when is it going to be fulfilling for you? And that is what gives me satisfaction. Uh, so know what your investment goals are. You don't have to have one goal. You can have n number of goals at different time periods. It's perfectly fine. And when you start thinking about your goals, you may also start worrying that how will I reach there? But unless once the first, you've done the difficult part, that you know when you need money, right? And then, very honestly, once you know when you need, at that point in time, when you will need it, you will manage it at somehow or the other, right? So planning for it before will make your job easier because now you know, right? I need this money at this point in time. So you will go ahead and plan and prepare for it. So the most difficult part is knowing why are you investing or what are your investment goals. So do that. That's the first thing. The second thing, obviously, is know when do you need it. This becomes important because when I know when I need it, it will then decide on where should I invest. If I have an invest, if I know that in the next 2 years, I will have to redecorate my home. So 2 years is a little short window for me to invest in riskier assets, right? Uh, So I will not want to invest in equity related instrument because 2 years volatility may sometimes impact my plans. But if I know that I have a 10-year window before I need money for my children's education or a 20-year window before I retire, then I know there is a time horizon where I can expose my investments to a higher degree of risk. So the time horizon becomes very, very important. I may also know that next May or next December, this December is just three. You may also know this December I want to go for a Christmas break, and I go every year go for a Christmas. So there is a recurring expense every December where you need money for a small break with your family or with your friends, whatever it may be. You can plan better once you know. But knowing when you need it is an important thing, and that's your time horizon thing. And one more thing which we should all assess is what is the level of risk that I need to take. So there are two types of risk. One, I need to take, and two, I'd like to take. There are two different things, right? So it's called one risk-taking need and one is called risk-taking capacity. For a lot of people, their risk-taking capacity or wish or need or maybe low, that I don't want to take take a lot of risk. But the requirement will be that they need to expose their investments to a level of risk. So what is your tolerance? This tolerance is a very funny thing. If I ask you, so whenever you're making an investment, your idea is that you're going to make money. And that's how, if I'm not convinced that this scheme, this investment, this asset class that I have chosen is going to deliver returns to me, I will not invest in that. Right? So I'm not thinking that my returns will be negative, but having risk tolerance to volatility is a different thing. And again, people actually say one thing, and when they experience it, they may actually think differently. So I may tell you that I am okay with a 20% or a 25% volatility. What that means is, if I, let's say, invest 1 lakh rupees, I'm okay with my portfolio showing 75,000. Okay, but when it's actually happening, I may panic. So it's difficult to ascertain, but somewhere you should be ready for some level of volatility. In fact, in finance, we say you should treat volatility as your friend, because when the markets fall down, that also gives you an opportunity to average out and put some more money in, and this average reduces your cost per unit. And because your cost per unit comes down, and whenever the market turns around, it kind of helps you, to make more money. So, but yes, you need to have a level of tolerance to volatility. If seeing your portfolio value drop temporarily keeps you awake, then really, you need to reevaluate your risk-taking ability, your risk-taking need, or your investment choices. So some appetite to stomach fluctuations, stomach volatility will have to be something which you will have to build. Because that's how the nature of the equity investment market is. And we'll have to absorb it. There is no choice. One more thing which we should all do when we are talking of returns is we should benchmark. Now, there are two ways in which you benchmark. One is obviously benchmark against an index. So for example, in mutual funds, all schemes have a benchmark, right? So if you invest in a large cap, Nifty 100 will be a benchmark. If you invest in a mid cap, Nifty 250 will be a benchmark. So different benchmarks which are there. So what we do is we compare with benchmark. Are we getting better than benchmark or no? If we are invested in an active scheme, if you are invested in a passive scheme, then are we getting as per benchmark or no is something which people track, right? So this is one way. Personally, I think I want to benchmark with my expectation. My expectation is, let's say, about 13-15% returns. 15-17%, whatever it may be. Let's talk of 13%. Okay, this is my expectation from my portfolio. Am I making that much or am I making more? That becomes more important for me rather than, a mid-cap index where I've invested has given 25%, but I have got only 22. It's okay, as my expectation was still from my portfolio 15%, and this scheme is giving me 22, because of which my portfolio return has gone up to 17%. I should feel happy, right? So benchmarking from my expectation is a little better rather than from benchmarking from what's happening in terms of returns versus scheme benchmarks. Yes, you must track whether a scheme is consistently underperforming or outperforming. If it's consistently underperforming, then you need to dig deep in understanding what is the problem. And if it's continuously outperforming, you need to also know what is working, for how long will it work, or was it even that you set your expectations a little too low? It happens sometimes, right? I am talking about 12 to 15%, but I've invested in a scheme where the average last 5, 7, 10-year return or since inception return has been 17%. Example. So I'm saying I want 13-15% return, but I've invested in a 17% average scheme. So, that's what you expect then, that this is a 17% scheme. Now, then you need to check whether it is giving me that 17% or it is giving me below or higher. And why is it going below? What is going wrong? If it's going higher, then what is working? And how long do you think this will work? So benchmarking becomes very, very important. You do it either as per an index key, I need more than this. But I think that's very generic and good for tracking whether schemes are giving returns better than a benchmark or no. For me, what matters is what is my expected returns. And if my expected return is X and I'm getting more than X, then I should feel happy because I need X or little more than X. Yeah? Because then my portfolio is beating my benchmark, and that is what is important because that's personalized. How much return do I want? No point chasing best schemes. I mean, if I'm happy, if I want 13-15%, my schemes are delivering that return. No point in doing anything stupid. Just stay put, stay invested because I'm getting the benchmark returns that I wanted. So, but you must do benchmark. Don't follow that what is happening. This scheme is doing well. This scheme has done that much return. What is my expectation was what I'm getting, I think works better. So that's your step 2. Step 3 is, decide what assets will you invest in. Now, this is the broad one where you think of your diversification strategy. You know, if you're going to invest in equities, then how much percentage should be in equities? If you're going to take fixed income, what percentage of your portfolio should be in fixed income? If you have money for real estate, and you're looking at real estate, what percentage of your investment should be in real estate? What percent of money should be in gold? Even if I talk of the more regular investment choices, then it usually falls into these four. But decide on a percentage. This percentage obviously will come from your requirement, from the average returns that you're expecting, and this will help you have a broader idea of what your portfolio should look like. So this is your step 3. I think again, we don't plan it, or don't design this, but somewhere if I were to look at most households, there will be some equity or equity mutual funds, there will be some FDs, some corporate bonds, and some gold in the name of investment, which is always there, right? So real estate, I'm not keeping it in the same vein because real estate today has become a play where your investment value has to be little high. So it may not be something where everyone is readily there. But but these 3 you'll see in most people in the name of investment is there. But it's not by design, it's not planned. It's basis. What I think at that point in time. So very soon there will be a festival season. During festival season, people think that buying gold is auspicious. So some people will go and buy gold, saying that it's an investment. Fair enough. I'm not saying no. But what percentage of your yearly investment is going in this? Same time, equity markets looking good, people invest little higher. Equity markets looking volatile today, then people move to fixed income. In few years back, it was the other way. Fixed income was more primary, for investments. And then when somebody was coming, showing, the bright side of equity, convincing me very hard, I used to try something, maybe do an SIP somewhere there, that. But today people are little more convinced with this idea, all of us, you and me including, and you're seeing that people are more open to the idea of investing in equity related instruments. But there's no design element where that this is the percentage of your money that is going there. It becomes very, very important. Diversification manages risk. It gives you the cushion to go through different market situations. And that is where a portfolio comes in. So do that, don't put all your eggs in one basket. And similarly, your step 4 is when you now get down into selecting where are you investing. If you're choosing schemes, then why are you choosing certain schemes in equity? In fixed income, is FD good enough, or should you look at the modern fixed income side where you're looking at mutual funds to help you manage your fixed income portfolio? And there are a lot of schemes which in the mutual fund side which can help you do that. On the equity side also, if you're investing in mid cap, then why are you investing in mid cap? Which AMC mid cap are you choosing? Are you choosing a small cap? Are you choosing a multi cap? Are you choosing a a sectoral or a thematic scheme, or are you choosing passive schemes in terms of the indices and the index plays that are coming in both sides? When I'm creating a portfolio, I could do an active or a passive. So active could be where I invest in direct equity through my demat, where I'm taking active calls and I'm buying certain securities, or I go through mutual funds. That is one way of saying I'm going passive, that I'm outsourcing the security selection bit to a fund manager. And in mutual funds also, then there are two ways of investing. One is obviously the active one, where you are investing in active schemes where the fund manager is very involved in stock selection, security selection, and basis selection is driving portfolio performance. And then in the recent past, we are also seeing a very strong thrust towards the passive schemes in the mutual fund side. Passive schemes are simply to understand the index replicating schemes. And right now there are also some very smart themes, where indices are getting created, like momentum, or low volatility, and high quality. A lot of smart indices are also getting an opportunity to be in the markets. And investors are even going there saying that, see, this is a smart index and we should take exposure. Over there also you can choose an active or a passive. So this active or a passive today actually is something which you can do first as a first hand, that this is something which I want to hold on to these securities or stocks, and then further on go on and create give some money in mutual funds. Or you go ahead and say, I don't know stocks, I don't have the time, I'm going completely mutual funds. Again, over there I can choose active and passive. On the fixed income side also, there is passive debt, which is huge. A hold to maturity concept works on that side. Or there is active debt, and you can choose either of. Again, basis your comfort on the portfolio, your comfort on what the scheme is doing, what's the endeavor of the scheme. But now you're in this step choosing schemes where you invest and you create your portfolio. See, the idea is now this is by design. And when you do it by design, now what is it that what's in it for you? What is it that you're looking for? What is it that you will gain? And this design, is something which becomes very important, because now once you know what is your goal, what is your time horizon, what is your risk that you can take, and basis that you created an asset allocation, diversification chart. And now in that diversification, how much money is going where? Now, you're ready with your portfolio. What becomes very important now is that I regularly monitor it, I measure it, and do a timely rebalance. The first thing is monitoring. You must check, that everything is as per expectation. How will you know it's as per your expectation? When you measure it. At least about once in 6 months, 1 year, you must measure returns. Are they in tune with your expected benchmark? Now, it could be, like I said, my own personal expectation or the overall expectation that I'm having in terms of the returns that the scheme is getting from the index. But, if I've created a portfolio, then your checks should be at two levels. One is, how is individual scheme doing? But more importantly, I should focus now on portfolio returns. See, what we have to admit and accept, that not all schemes will perform all the time. So some schemes will perform better, some schemes will perform less. And what happens, when I'm seeing my portfolio returns, I start seeing some schemes which are doing well. I pat my back saying that, wow, this is doing well, I chose well. And then, my entire focus very quickly starts moving towards those schemes which are not doing well. And I start wondering, have I made this right choice? Should I remove this money and put in this better performing scheme? And then, if I do that, then Murphy's law hits me, where, this scheme where I remove money from starts doing well. See, understand, portfolio is created to absorb different seasons. Right? And that is how a portfolio should be created, to help you manage different situations in the market. So not everything will perform at all times. Sometimes scheme 1, 2, 3 will perform. Sometimes scheme 2, 4, 5 and will perform. Sometimes scheme 1, 5 will perform and 2, 3, 4 will not perform. But you have to check whether you have made the right choices. And you have to measure whether this portfolio is giving me the returns that I expect or what my benchmark returns are. If overall portfolio is performing, overall portfolio still looks healthy, you may not need to make a lot of changes in terms of churning portfolio. That this scheme is not doing well, let me remove money from here and put it in the good performing scheme. You may not need to do that. So measuring is important, but when you're measuring, a lot of us just focus on the ones which are not doing well. And because then they are not doing well, you have options over there which are clearly, the well-performing ones in your own choice of investment instruments that you have chosen. It's very tempting to move. You need to stop doing that, because there is a reason why you created a portfolio. There's a reason why you chosen those very instruments and schemes. So always remember those reasons. So measure, but not every time you measure is a reason to change. What is important is that you must rebalance. There's a reason why you did this asset allocation or portfolio split. It could be 60-40 in equity debt. It could be 70-30. It could be 50-50, 80-20, whatever it may be. But there is a reason why you come to that number as your comfort number or an agreeable number. So if you don't rebalance and you don't do anything, over a period of time when, let's say, the volatile assets start performing, you will see that it starts getting skewed. If I started with a 50-50 and markets are doing well, you may very soon come to a 70-30. And you feel happy, I'm making money. But the point is, if I'm comfortable with 70-30, why did I start with a 50-50? If I would have started 70-30, maybe I would have been at 80-85. I would have made more money. But if I've chosen a 50-50, 60-40, 70-30, the idea is I am somewhere decided upon the fact that this is what is comforting for me. So make it comforting. And how will you do that? You will do that only by rebalancing. So you must look at rebalancing. We have a very nice program on our YouTube channel called 3 Simple Ways to Rebalance Your Portfolio. Maybe you can check that out, to know more about how can you rebalance, but you must rebalance on a yearly basis at least. If not, you don't need to do it very frequently. A yearly basis is good enough. If not ever done, start now. So this is your last step. And this step ensures that you are tracking your portfolio, you are monitoring your portfolio, you are measuring your portfolio, and you are rebalancing it to ensure that your portfolio is in the comfort level of risk that you are okay with. And this is very, very important as an investor for me. So finally, before you look at the future, know your present. So you should know where you stand, know your finances, understand your risk tolerance, your returns that you want. Everyone wants high returns, doesn't want to take high risk. Will not work. You will have to expose your investments to a certain degree of risk for the returns that you want. I mean, if it's, into the newer investment avenues, how will you know whether your investments are performing? You will only know when you have expected returns in terms of a benchmark. So benchmark it. Then basis that, create a diversified asset allocation strategy. Invest into actively managed or passively managed, depending on what your choice is. And once you've done all the hard work, monitor, reassess, and rebalance. This is what I had for all of us. Any one of us having any queries or questions, I'll be more than happy to take them now. So there is a question that the returns on fixed or corporate bonds are almost very low, around 7%. Yes, today they are at a low, but that is why, you could smartly invest into certain mutual fund fixed income schemes, which may take advantage of the interest rate cut cycle, which may happen sometime in the next 9 months to a year. And these can help you get better returns from the fixed income side. But of course, please, look at portfolio, look at its ratings, and basis that make an informed decision. If you don't know how to do this, you can obviously go to a financial advisor, take his help, to understand how this can work. But it's something which you must do. So passive management, like I said, there are two ways. One is, I have decided that I am going to control my investments by actively choosing the securities where I'm investing. So I will create an active security portfolio. So I will invest in stocks, like in a demat. That I don't want mutual funds. I think I have better control in stocks that so that's there. These are good for people who have knowledge, who have time, to track, and people who are more into active trading or active investing. Or then you go to mutual funds, which is more passive, where now you have decided I want to take exposure in mid cap, but I don't want to take the headache of choosing which mid cap. So what do? I choose mid cap and I let it be. Right now, the fund manager, the portfolio manager over there decides on from the 150 universe of the mid cap, which ones he wants to pick. Let him do it. You have to trust your money somewhere. So this is one way of active and passive where I decide. Now in mutual funds also there are active and passive schemes. Active schemes are where fund managers are more actively involved in security selection, and passive schemes are where you are actually investing in indices or an index. So you invest in an index. So this scheme is replicating the index. So it becomes easier in terms of how much return will you get. You'll get returns as per index. So, that's how it works. So there's a scheme, there's an investment on international investments. International investments may be a great diversification strategy, but it's something which should be a little more informed decision in terms of what is your view on that country, what is your view on your exchange rates, and all of these should be something which you should consider before taking international exposure. But it's a great diversification strategy, and it can work in your favor if you do that. Does debt MF have an edge over bank FDs anymore, especially after abolition of capital gains for debt MFs? Yes, there are a lot of schemes which can help you take informed calls in terms of interest rate cycles and create decent gains in your portfolio if you do it right. So debt MFs can be a very smart choice in comparison to traditional FDs. So there's a question on thoughts on taxation and holding period for a portfolio. Again, holding period has to be personal. I could have a short-term requirement and I could create a portfolio for that. I could have a very long-term requirement. I could create a portfolio for that. So holding period is something which is very personal depending on when I need my money. Taxation, again, is something which is not in our purview. It is something which the government decides we have to follow. So again, and what we need to remember is taxation happens on capital gains when I withdraw. So, that's how it is. I mean, and we need to follow the rule of the land over there. So since there are multiple channels for investments, there are multiple PDF, Excel reports, but a consolidated view is difficult to obtain. So a consolidated view usually comes from, CDSL and NDSL as a consolidated account statement. If that is not sufficient, you'll have to perhaps just create a portfolio somewhere with all your investments, which you can track. But I think CDSL and NDSL do share, a consolidated account statement with all of us. If I'm not mistaken, every quarter, but definitely every 6 months. There's a question: how much exposure should each have in different investment baskets? Again, depending on how much returns are you expecting, what is the risk that you are okay with in terms of volatility. You'll have to decide on your percentage, and only basis that you cannot have an ideal number because it doesn't work. It has to be investments is a very, very, very honestly personal journey. It's my requirement, right? My requirement will be different from yours. And hence, There cannot be a general number which I can tell you. Anyone else, if there are any other queries, questions, then I'll be more than happy to take them before we can end our video. We'll just wait for a minute more. If there are any last minute questions which anyone thinks of, please put it in the chat and I'll be more than happy to respond. Okay, great. Thank you very much, as usual, for your time and the lovely questions. It's something which genuinely tells us that you were listening to us, and that's very encouraging. And once again, thank you very much. We'll connect again in the coming month with another program. Till then, goodbye and take good care of yourself. See you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.